Dando inicio entonces con la conferencia titulada The Future of Upstream for Survival to Revival, les pido recibir con un fuerte aplauso a nuestro orador, Dan Pratt, Vicepresidente de Upstream Research and Consulting en S&P Global Commodity Insights. Dan, the stage is all yours. Please join me.
Thank you very much, and good afternoon, everybody. I'd like to start by thanking Amexi for the opportunity to speak today. It is my privilege and my honor to be able to share some thoughts with you here today. It's great to be back in Mexico. The weather's been beautiful the last few days. The city looks amazing, and I'm glad to be back. So the title of my presentation is called The Upstream Sector, Survival to Revival. And so why did I come up with this title? So many of you may be familiar. At S&P, we host a major energy event every year in March. We think it's the premier energy event called CERA Week. So last month, we hosted 10,000 attendees, 2,000 companies, representatives from over 80 countries, over 80 ministers in Houston for a week to talk about the major industry trends that we see in the market today. And what was interesting to me at this year's CERA Week was the comparison to CERA Week just nearly a couple years ago. The CERA Week in 2022, 2023 was very, very much focused around energy transition. And to the point where they were even questioning kind of the survival of the upstream sector. Would the upstream sector survive in the long term, given peak oil demand, given the trends we were seeing and the hard pivot towards energy transition? And then this year, it was a very different tone. It was much more, as we kind of called it, the upstream revival. So upstream is back. There's excitement around the upstream. There's appetite for investment in the upstream sector. So it was interesting kind of seeing how in just 2 years, we've gone from survival to revival. And it's a reminder, I think, for everyone, just how quickly things can change in the energy sector. So just like Scott this morning, I'm also going to take you on a little bit of a personal journey. I graduated from college and entered the industry in 1997. So I started my career in less than 1 year later, in 1998, oil fell to about $10 per barrel. So for any of you who kind of remember that time, it was a tough time in the industry, very difficult, a little bit scary for someone who was new to the sector. And I graduated with an economics degree, in economics and business finance. So I've been I like to read The Economist from time to time. So if you look at kind of the economists over the years, you can see in 1999, they came out with the title Drowning in Oil. And the quote from The Economist at the time was that crude was gushing from the ground. And they predicted that this would be the new normal for the oil markets. And they also predicted that that would be the end of OPEC's power over the oil markets. In 2001, they declared that the world was addicted to oil. And then in 2003, they also declared, just 4 years after saying that we were drowning in oil, and just 2 years after saying that we were addicted to oil, they declared that it was the end of the oil age. So back then, in 2003, it was hydrogen fuel cells that were going to revolutionize transportation. It was biofuels. And every big car maker had a fuel cell program, and every big oil company was busy trying to feed new cars hydrogen. And then just 5 years after the end of the oil age, oil hit $135 a barrel. So, there you can start to see their claims that at those prices, at $135 a barrel, that would permanently reduce oil demand and curb oil use globally. We started to hear things in the market about carbon taxes and electric hybrid cars. And then in 2010, 2012, 14, we had the shale revolution in the US. And very early on in that revolution, there was a lot of, I think, appreciation for the energy sector. We were coming out of 2008 and the financial collapse, going into 2010. The energy sector created very low energy prices in the US. It created a lot of jobs. It helped the US recover from recession much quicker than the other countries around the world. But towards the end of that shale revolution, there started to be a lot of complaints from investors that you could never make money in shale, that the declines were too steep, you were drilling too much, you were overspending, you would never generate returns for shareholders in shale. And of course, today we know that is very different in the US. They were generating high returns, which we'll talk about. So then you go to 2019, and there you have what we call the crude awakening. And you can see this was the broad recognition in the market on the impact of emissions on climate change. You go into the pandemic in 2020, 2021, and there was a hard pivot towards energy transition. Many companies, especially the European IOCs, pivoting hard into energy transition, announcing reductions of investment into their oil and gas plans, plans to reduce investments, plans to reduce production, and many become kind of broader energy companies with investments directly into renewable areas such as wind and solar. In 2022, that title is called The Power Play. So this highlights the rapid rise we see in energy security around the globe post the initiation of the war in Ukraine. Energy security, energy affordability, energy reliability leaves rise to what we now see in terms of this upstream revival. And then in 2024, they published The Long Goodbye. So this is recognition that there's difficulties negotiating the energy transition as countries around the world are transitioning at a different pace, and recognition that oil and gas is much more durable in the long term than we thought a couple of years ago. So this was my career in the oil and gas industry over 27 years or so, as dictated by the cover of The Economist. And I think what's important here is to remember that it's beware. My message to this audience would be beware the short-term market sentiment. I think it was mentioned this morning that it's really important to have a long-term view on the market and plan accordingly. So what is our long-term view at S&P? And I think Scott left already from this morning, but he probably was peeking at my slides a little bit because we have something very, very similar. So just to kind of reiterate, so this is how we look at global energy demand. And you can see the title there, that this demand growth requires long-term durability for oil and natural gas. And it's not an energy transition, it's an energy addition. So if we look at oil and gas, at the end of 2023, it's about 53% of total energy demand. And yes, as we go forward to 2050, we do see growth in other areas. We do see growth in renewables. We do see growth in nuclear. And we do see some decline in market share for oil and gas, but it's not falling off a cliff. It goes from 53% to 46%. And if you include coal, it goes from about 80% of the market down to about 60%. So again, it's not an energy transition, it's an energy addition. We are going to need all sources of energy because as Scott talked about this morning, that pie is still growing larger and larger. And this is almost in a somewhat kind of calm scenario. If we have large market disruptions and discord in the environment, we might need more oil and gas than we are producing today. You know, one of the things that was interesting when there was this large focus on energy transition a couple of years ago, what you heard was how much collaboration it was going to take to achieve the goals of net zero. You are going to need collaboration between governments, between the private sector, the public sector, citizens. I would argue today, we're not heading down a strong path of collaboration globally, right? So this could look very different in 10 years in terms of what we might need from oil and gas. I think a couple of other areas, other market factors to be aware of as we look at this new age revival that would be very different than what we saw kind of pre-COVID. So this is the historical S&P weighting by sector, and there's two critical lines there that you should be aware of. The red line, the dark red line, is the energy sector. So you can see the energy sector over the last 20 years or so, as a percent of the S&P 500, has been seeing its weighting reduce quite significantly. From about 15% to a low of about 2% during COVID, came back up to about 5% and been declining in the last year or so, back down to about 3%. The other line that you should be aware of is that blue line. So that blue line is technology. And you can see how technology stocks have grown quite rapidly over the last 10 years. So what does this mean for the oil and gas industry, right? One, I think it's important to understand that competition for capital is going to be tough on the broader markets, right? Money is flowing into the technology sector. It's seen as a high growth sector. I would argue over this trend, oil and gas has gone from more of a growth sector to a value sector. If you look at the multiples companies are earning today relative to the cash that they are generating, their valuation multiples are much lower today than they were pre-COVID, right? So you can see the investor demands on companies have changed quite dramatically. Investors are asking for more capital to be returned to them in the form of dividends and share repurchases. They don't want to see companies investing all of their cash back into the business. They're asking for capital to be returned to them. So in my opinion, the sector's gone from a bit of a growth industry to much more of a value industry. I think the other thing that is important for this audience to understand is competition for people, right? And the tech industry is very attractive for young people coming out of college. It's high growth. The sector's doing well, and it's difficult to recruit against that, particularly in the industry that we are in. So those are two very important things, I think, to keep in mind that are different about this revival than may have been in the past. But this shift in investor preferences has also changed the business models for companies. So capital allocation is much more focused on maximizing returns to shareholders. So what are we looking at in this chart? If you look at kind of the x-axis, anything above the x-axis is cash, sources of cash. So operating cash flow, divestments, net debt increases. Anything below the line are uses of cash. So you have organic CapEx, you have share repurchases, dividends, and any debt payments. And what you see kind of in the first decade of this is that companies were spending or reinvesting about 80%, 90%, sometimes more than 100% of their cash flow back into the business. And then you have this shift in investor preference of wanting more capital returned to them. And you can see that in starting to come in 2020, 2021, very strongly as they come out of COVID. You obviously had the energy transition as well, but you can see where companies were only reinvesting 20, 30% of their cash flow at a low, 40%, 50% the last 2 years, and we see that leveling off at about 60% going forward. So only about 60% of the cash flows are going back into the business. 40% going forward are going back to investors in the form of dividends and share repurchases. So this changes kind of the type of assets that companies want to invest in the future, right? They want to invest in assets where they can quickly convert discoveries into production, bring that cash on sooner, bring it on quicker. They're also looking for more size, more scale to drive the type of returns that they need to support 40% of their cash flow going back to investors. So return of capital has become the business model. How successful has it been? Well, if we look at kind of the performance, relative performance in the marketplace today. So this is the Brent crude price. So this is the relative performance of Brent benchmarked back to, I think, the end of 2006. And you can see the volatility there. If you look at WTI, it pretty much tracks pretty closely to the performance of Brent. You can see there's a little separation there during the years that the shale revolution took off in the U.S. WTI prices relatively lower than Brent as that supply was coming on. If we look at how the shares performed over that period for the different peer groups in the upstream sector, if we look at the E&P index, you can see that the E&P index tracked almost line for line the performance of the oil price, particularly WTI, until you get to 2020, right? And that period of where investor preferences shift and they want to see more capital return to shareholders. So here you start to see as prices fall in 2014, 2015, continue to fall in 2018, the S&P shares, the independents, I would say, particularly the U.S. independents, their performance underperforms the commodity price and has still underperformed even as commodity prices start to come up. If we compare this to the Dow Jones Integrated Index, and this is going to be heavily influenced by the Western IOCs, so Exxon, Chevron, and you can see in the first half of this chart, very different performance. So these are integrated businesses, integrated companies, so they didn't quite trade as much with the commodity, right? They have downstream, midstream, chemicals, refinery assets. So much more of an integrated business, less volatile than the commodity, as you would expect. So as prices were going up, they were more steady. As prices were coming down, they were more steady. But then what do you see since 2020 in this shift in business model and shift in investor preference is that return of capital to shareholders, 40%, 50% going back to shareholders, have led to a relatively strong outperformance of their shares, both relative to the commodity and both relative to the independents. And there was a big difference in terms of what we saw with the Western IOCs, Chevron, Exxon, and what we saw with the European IOCs, BP, Total, Shell, others, in terms of that performance over time. So those companies that pivoted hard into the energy transition and invested in what I would call electron generation, wind, solar, other areas, had a difficult time generating the type of returns from those investments in order to support that return of capital back to their investors. And so they took notice, right? And if you look at a broader global integrated index, you can see how the Western IOCs, who doubled down on traditional oil and gas with investments and acquisitions in the Permian, got more oily, generated strong returns. Those European IOCs took strong notice, and what we've seen over the last year, year and a half, is a pivot back to the upstream sector, right? So if we look at Shell and Total, they sell right down their interest in offshore wind. E&I starts to spin off some of its low-carbon businesses. Equinor starts to cut its investments in half, and BP does a total reversal in its strategy, right? So coming out of the transition, BP had a target to reduce its oil and gas production, and now, a few years later, that strategy is completely reversed. You have a new CEO, and now they're looking to rebuild their oil and gas portfolio and grow their production. Right, so this is them taking a look at how Exxon and Chevron and others have performed and making a pivot back to traditional oil and gas. And I would say that their low carbon investments haven't completely disappeared. They have just shifted, right? They've gotten rid of some of the renewable parts of that, some of the electron generation parts, the wind, the solar, and where they're pivoting to is more akin to their core capabilities, right? So they're pivoting to carbon capture. They're pivoting to geothermal, they're pivoting to lithium and others. So more molecule management and less electron generation. And then lastly, I would say one other thing to kind of keep in mind that's different than what we've seen in past cycles is even though we're seeing and hearing more companies wanting to do exploration, and I'll talk about that in a second, is we are actually at an all-time low for exploration in the industry. So if we look at what we consider new field wells drilled, which is that black line you see on the chart, that peaked all the way back in 2008, ironically, or maybe coincidentally, as the same time the energy sector peaked as part of the S&P 500 weighting. So our exploratory activity peaked in 2008, and we've been exploring less and less each and every year. So you can see the number of new field wells in 2004 was about 75% less than it was in 2008 and 60% less than what it was in 2014. And if you look at the discovered volumes from new field wells drilled, we only discovered about 8.8 billion BOE in 2004 from new field wells, and that was the lowest amount of discoveries we had since 1952. So we're at an all-time low in terms of exploration activity. But we think that there's going to be a recovery from the bottom. So we'll talk a little bit about that. So those, I would say, as we look at this new wave revival that we're seeing in upstream, keep these things in the back of your mind and how markets are also transitioning. It's not just this industry, it's the broader markets, it's investors, it's the business models. All these things are transitioning at the same time. So what are some of the key lessons that we've learned from CERAWeek? First of all, as I talked about, the rise of energy security, affordability, reliability is taking precedent all across the world. And so, we are seeing it's not necessarily an energy transition, but rather an energy addition. And the revival is going to be very different than what it would look like pre-COVID. At CERAWeek, we had the new Secretary of Energy from the U.S. administration. We had the new Secretary of Interior. And you heard the mantra, drill, baby, drill, right? And so that was very much, I think, the mantra on stage at CERAWeek. Off stage, in the hallways and private meetings, it was a little bit more like, chill, baby, chill, right? And so, and what I mean by that is very much what I talked about with the new business models, right? So these companies, I think, are very appreciative to have an administration in the White House that's going to be more supportive of the oil and gas industry. It's going to reduce regulation. It's going to make it easier to do business. They really appreciate that part of it. But I don't think there's an appetite, particularly among the U.S. independents, to necessarily ramp up their organic spend, start spending more money, raising costs. There's still a kind of a mandate to reduce costs and be more efficient. And I don't think anybody wants to see the U.S. production start to increase and prices come down. So I think there's that kind of dual kind of talking points that we heard at CERAWeek in terms of the appetite of companies to actually increase activity. The only exception might be gas. We can talk about that a little bit too. There is an appetite there depending on the amount of demand we see from LNG exports. So there's an opportunity in the U.S. Yes, there's certainly enough inventory in the short term in the U.S. unconventional to grow production should you want to. Pretty much at this point, the more cash you put in, the more production you can get out. But I don't think the willingness is there at the moment. There's also, I think, a big demand on infrastructure and the supply chain in a scenario where you're ramping up activity. That's also a big constraint, particularly on the gas side. And then you had OPEC. We had a lot of NOC companies there from the Middle East reminding everybody that they still have capacity, and we saw them announce an increase in their production the last week or so. What else? I talked about exploration fever. We are coming off a bottom. I've been doing quite a lot of traveling in the first quarter of this year. I've been to Europe a couple of times. I've been to Asia. I was in India for India Energy Week. I've been meeting with a lot of exploration teams, a lot of business development teams, new venture teams, and everywhere I go, there's a stronger appetite for exploration, right? So the teams are feeling more confident. I think they feel more support from their board of directors to explore more. Sounds like they're getting more financing. The banks are starting to call them more than they did a couple of years ago. So there is a willingness out there to ramp up exploration activity. I will say, though, that we really haven't seen the rubber hit the road, so to speak. So what needs to happen, right? I think as you look at these companies, and they're all starting to look at the best plays, right? They're all looking at Guyana and Suriname and Brazil, and they're realizing that those plays are highly competitive and they're highly expensive. So now they're starting to look at that next tier of plays, right? So where can I find that resource opportunity, and how much risk are these companies willing to take? Because a lot of those opportunities come with a little bit more above ground risk, right? A little bit harder to monetize your investment, a little bit harder in terms of the ease of doing business. And then the other side of that are, what are governments going to do? So when I was in India, they announced their new bid round. Libya announced their new bid round recently. And all those governments are saying that they need to improve their fiscal regimes, they need to improve their regulatory environments, they need to make it easier to do business in order to attract investments into their country. So we are starting to see governments say the right thing. Time will tell if they actually kind of do the right things. And then a big topic at CERAWeek, and we heard it today a lot, how do you power power? Right? And everything is on the table, right? We're kind of joking a little bit during CERAWeek that it was a little bit more of a natural gas conference than anything else. A lot of focus on natural gas globally, whether it's these developing countries looking to electrify their societies, or whether it's AI data centers and the need to power those. So all options are on the table: gas, nuclear, renewables. I think Scott mentioned this morning that Trump has put out several tweets about ramping up coal production, clean, beautiful coal, in his words. But you need to realize kind of what's behind some of these messages that Trump is sending into market. You can't disconnect the energy dominance that the Trump administration talks about and the technology dominance that they're trying to achieve. Right? So why would Trump be promoting coal? Well, because the U.S. is a race with China to achieve AI dominance, right? So we want to make sure that, or the Trump administration wants to make sure that we have enough power to fuel these data centers because they're trying to win the race of AI against China. So these things are highly interlinked. You can't separate the energy from the technology. So critically important to kind of keep that in mind as well. And then lastly, 3 T's, Trump, tariffs, and trade war was a big topic. And I would say the takeaways, particularly for the folks in this room, is what does the Trump administration and the way they operate, how is that going to impact government-to-government relations in the future? While I'm in Asia, I'm hearing talk of more kind of east-to-east partnerships. Should they be looking to their own regions to partner more? Should they be looking to the Middle East to partner more? Obviously, Europe is going to have to come together after a post-Ukraine settlement, and what is that going to look like? What happens as the U.S. continues to isolate itself? And what does that mean for Latin America? So think about what partnerships might look like, past, present, and future. And then lastly, it's kind of the uncertainty of it all, right? So there are certain policies that are promoting activity and increasing, and then there's the policies that are restricting, raising costs, and other things. So, uncertainty equals inaction in the marketplace. And we've seen even this week, Trump trying to kind of balance that swings that we're seeing in the marketplace. So this looks at kind of the first Trump administration and the performance of the S&P 500 versus the new this year's performance in his new administration. And he's going to be challenged, and there's going to be a lot of pressure from companies and CEOs and investors in the U.S. as the markets react to some of the inconsistencies and the uncertainty that we're seeing. So I think that's it. Appreciate everyone's time. Thank you for listening. I think we're going to do some questions.
Thank you, Dan, for your presentation. As you said, we're going to begin a conversation. Para moderar esta sesión, cedemos la palabra a Alejandra López, coordinadora del Comité de Asuntos Externos de Amexi.
Thank you very much, and thank you very much, Dan, for this presentation. It's, I think you just gave us a very good overview on what's going on right now in the energy sector. We have just a little time to conversate, and I have just a couple of questions. The first one, you talked about the New Age revival, that it's different from past cycles. What does that mean for Mexico?
I think it's a great question. I think it's a great opportunity for Mexico. As I'm out and I'm talking with companies and I'm talking with exploration teams, they're looking for opportunities to invest and multiple opportunities, right? So I think Mexico, from a resource standpoint, has so much to offer. There's a lot of interest in deep water globally at the moment. There are companies out there that see themselves as exploitation experts who can come into mature assets and help revitalize production. There's a lot of interest in unconventional. And the thing about Mexico is, if you think about what these companies are really looking for, it's resource opportunity on one axis and investment favorability on the other axis, right? There's only one of those accesses that you can control, right? You either have good geology, you either have the rocks, or you don't, right? And in Mexico, I think it is in a favorable position because it has strong resource potential, right? And you want to be in that upper white quadrant for investors where you have strong resource opportunity, strong investment or high favorable investment environment, and that's where companies are going to go to because, again, they're supporting a business model where they have to return 40% of their cash flow back to shareholders. So Mexico has a tremendous opportunity. You have assets that are onshore, offshore, deep water. You have exploitation opportunities, exploration opportunities, unconventional. So it's really how do you move into that core quadrant? How do you make this a more a favorable investment environment that will attract that? So I think the opportunity is strong.
Fantastic. And another part of your presentation, you mentioned the trade that Mexico has with the U.S. is mostly based in terms of energy, mostly based in natural gas. So how does the outlook for S&P looks in terms of natural gas and the scenario for Mexico in the upcoming years?
Yeah, I think our outlook for natural gas, we do see, we believe the growth in LNG exports is going to come predominantly from the U.S. or largely from the U.S. over the next couple of years. So we see natural gas prices going to about $6 or so per MCF in the U.S. in 2026, 2027. Our forecasts differ a little bit from other forecasts that you might see out there. Other forecasts have the natural gas price, Henry Hub, continuing to rise post-2027. We actually see a little bit of oversupply of LNG at the end of 2026, 2027. So we think prices will start to come back down more into the $4 or $5 range, mid to long term after that. But we do see prices increasing in the next couple of years. And so I think for Mexico, number one, you should prioritize growing your local gas resources. That should be a priority. Again, energy security, energy independence is critical and important. But I would say in absence of that, and I talked about this a little bit, try to think, who are your new partners of the future? What other sources of supply are out there? And I would say, Mexico should be thinking about, how do I diversify my natural gas imports at a time when Canada is probably trying to figure out how they diversify their natural gas exports, right? So there could be a nice kind of a new partnership there, and maybe you cut out the middleman, I don't know. So.
Perfect. And just one final question. You highlighted before that the need for new or different types of partnerships in the industry. You mentioned that, but could you explain a little bit more about what you mean about different partnerships?
Yeah, I think we see it in different parts of the world. We see in the U.S. it's been predominantly driven by M&A. Mergers and acquisitions are happening and have been happening pretty strongly over the last couple of years. Internationally, it's a little bit harder to do kind of those corporate acquisitions. There's been a few that have been successful at it, but largely it's a little bit harder. And so what we see there more is kind of joint ventures, where companies are combining parts of their portfolio in order to specialize, to focus, and also to realign their portfolio. So we see, I think, a rise in joint ventures. And again, I think when you think about new partnerships, is really around those regional alignments that I talked about earlier. Again, with Asian companies aligning, I think, stronger. European companies are going to be aligning stronger. And so what does that mean for kind of the Americas? And what are the partnerships of the future and other companies in Latin America? So I think it's regional alignment. And then, you're going to see a lot more, and I think different types of joint ventures. It will be interesting to see. I know we saw BP sign kind of a service level agreement in India. To be honest, I don't think there's a lot of companies out there that, at least the oil and gas companies, who are looking for those types of contracts. I think for many of these companies, they want to own reserves, they want to book reserves. And so I don't see at least among those kind of integrated group of companies, a strong push towards those service level contracts.
Fantastic. Sorry, we don't have more time to keep talking about this. We have another roundtable right next after us. So thank you very much, Dan, for your time, for this wonderful conversation. Thank you very much.
Appreciate it. Thank you.
Thank you, Dan. Thank you, Alejandra. Please stay a little bit more because we have a gift for you for your presentation. Invitamos a Zaira Torres, que nos va a ayudar a hacer entrega de estos reconocimientos. We kindly ask to pose for a photo, please.